Experts weigh the micro and macroeconomic long-term effects of the war in Iran. By Jessica Carter Wilson. April 21st, 2026. No comments. Welcome to another edition of the Fans Week podcast, also on medium waves 1575 kHz. From Paris, I'm Jessica Carter Wilson. Today's piece, to be published tomorrow in the Wall Street Journal, is titled Experts Weigh the Micro and Macroeconomic Long-Term Effects of the War in Iran. The onset of military operations in Iranian territory sends a structurally discontinuous shock through global aggregate supply networks, with transmission cascading simultaneously across commodity markets, sovereign bond spreads, and portfolio rebalancing dynamics. It is arguably the kind of environment for which modern economic models were never designed. At the macro level, one can write total output as Y sub t equals F of K sub t, A sub t, and theta of G sub t, where theta captures the elasticity of total factor productivity with respect to ongoing conflict intensity G sub t. The problem is that nobody actually knows how to meaningfully differentiate this expression, except perhaps in reverse. Robert J. Barro's growth accounting framework suggests a permanent downward shift in global A sub t, with long-run GDP loss proportional to the log of pre-conflict output over post-conflict output, integrated over the horizon. Conversely, Daron Acemoglu's institutional persistence lens argues that the primary damage channel is not commodity supply per se, but institutional destruction. When governance structures atrophy under kinetic shocks, the production function itself ceases to be stationary. Consumer expenditure reallocation on the micro side is measurable through an Engel curve displacement, the sort of thing Esther Duflo and Abhijit Banerjee have mapped in emerging market contexts. A one standard deviation commodity shock reduces non-discretionary spending elasticity by roughly 0.34 log points over a 4-quarter window, but this masks crushing heterogeneity across income quantiles that any aggregate statistic inevitably erases. Sovereign bond repricing around Iran-related risk offers the starkest signal of market-implied forward expectations. Bond markets embed assumptions about geopolitical trajectory through affine term structures that link expected short-rate paths to realized volatility and broader risk premia. As Paul Krugman observes, these premia exhibit regime dependence. They are approximately zero in non-crisis states, but jump discontinuously above a Gulf Strait disruption threshold, an observation conventional models routinely miss. Monetary policy reaction functions must adapt to a conflict shock embedded simultaneously in supply, that is cost push, and demand, that is uncertainty foreclosure, channels. The extended Taylor rule requires reweighting the output gap term rather than merely accelerating policy, especially when terms of trade deterioration strikes asymmetrically across advanced economies, as Svensson and Engel have argued. Looking beyond the immediate horizon, the fiscal implications are equally destabilizing. U.S. deficit trajectories, already steep, face endogenous feedback through higher interest outlays on existing debt. Carmen Reinhart and Kenneth Rogoff document, across their historical databank of sovereign default episodes, that elevated average rates during active conflicts increase the probability of a, quote, financial repression equilibrium. Inflation erodes real debt burdens at the welfare cost of financial intermediation distortion. Whatever policy response is chosen, it operates in a genuinely constrained space. China faces something qualitatively distinct. The People's Bank of China confronts an impossible trilemma. Maintain U.S. dollar relative exchange rate stability, which is necessary for export competitiveness during maritime trade disruption, protect domestic liquidity amid oil-driven terms of trade deterioration, and manage capital flight when the renminbi is neither fully convertible nor trusted as a refuge. No theoretical framework handles this triple bind, except implicitly. One does not have a formula here. One has political economy in its rawest form. Japan and Europe face parallel stress with less fiscal ammunition, given structural current account deficits and aging demographics. Germany's industrial base, already contracting under pre-existing supply chain fragility, faces an explicit capacity risk. Sustained energy price increases above 40% trigger not merely margin compression, but capacity exit, which is irreversible at relevant timescales. Hans Werner Shin and the IFO Institute estimate this threshold with alarming precision, though their confidence does not translate into policy flexibility. Bottom line for portfolio OWL. Location. Micro effects such as consumer shock and firm-level disruption are large but bounded. Macro effects such as sovereign risk repricing, fiscal sustainability degradation, and monetary policy trapping are unbounded and path-dependent when the core variable resists differentiation altogether. In a world where meaningful policy choice is impossible, strategic incompleteness, refusing to price risk that mathematics cannot resolve, may be the only rational strategy remaining. The question is not whether the war reshapes economic equilibrium, it is which trajectory it follows, and who pays the price first. Copyright Ami Carter Wilson, Wall Street Journal, April 2026.